APAC's asset and wealth management industry recently saw further evidence that APAC's NextGen investors are more likely to change their wealth managers. Singapore's private banks look to recruit their up-and-coming high-net-worth individual clients. Hong Kong passed legislation to establish a stablecoin regulatory regime and framework, and China start to aggressively tax overseas investments. Let's take a deeper look at these, as well as other headlines and developments. Starting off in APAC. APAC's wealthy have a greater willingness to change their wealth manager compared to their global peers, as per research from EY, a global network of firms providing accounting and consulting services, with the trend even more apparent in China. The main reasons for switching cited were investment performance, broader product selection, more specialist access, and better digital tools. 36% of respondents in APAC indicated that they were likely to change their wealth provider in the next 3 years, compared to the global average of 29%. Respondents in China reported that 51% of them would make the change. 74% of APAC respondents expected to shift 1/4 of their portfolio, 48% plan to move up to half, and 25% over half their portfolio away from their primary wealth provider. Further, the survey showed that 72% of APAC respondents expected their wealth manager to utilize artificial intelligence in some capacity, compared to the global average of 60%. This matched with a similar difference in the level of trust in such offerings, with nearly half of APAC respondents stating they trusted AI-powered tools as much or more than human advisors. This compared to the global average of 38%. In response to market volatility, 51% of APAC investors have increased the number of planning meetings with their financial advisors against a global average of 44%. With regards to investment allocation, real estate remained the APAC investors' allocation of choice, with 68% of respondents having it in their portfolios. Over 30% expressed a willingness to invest in alternative assets like collectibles, artwork, hedge funds, private credit, and secondaries markets. The survey had 3,587 respondents and took place between 30 October and 24 December 2024. APAC accounted for 1,153 respondents, North America 1,113, Europe 1,006, the Middle East 162, and Latin America 153. Wealth segments across the following categories were covered: mass affluent, $250,000 US to $1 million US, high net worth individuals, $1 million USD to $4.9 million US, very high net worth individuals, $5 million USD to $29.9 million USD, and ultra high net worth individuals with over $30 million US in assets. The generational breakdown across these investor categories is shown on this chart. Millennials are aged 25 to 41, Gen X from 42 to 57, and boomers 58 years and above. The full report is available via the QR code shown. Do check it out. Moving on, a report from BBH, a global United States financial institution, shows that ETFs continue to grow across Greater China, as the region accounted for 71% of total APAC flows over 2024, amounting to $347 billion US. Key findings from the report are: demand for ETFs across Greater China is outsized compared to global growth. Active ETFs are gaining traction across the region, especially in Hong Kong and Taiwan. Defined outcomes, or buffered ETFs, are at the forefront of investors' minds. Cryptocurrency ETFs are increasingly demanded, especially in Taiwan. Tax efficiency is a key consideration in Hong Kong, and active ETFs are seen as holding opportunities for fund managers in Taiwan. The results show a marked increase in support for ETFs from the prior year's survey, with all respondents in this iteration stating they plan to increase their ETF allocations compared to 66% from the year prior. Within the three markets encompassing Greater China, 40% of respondents in Hong Kong and Taiwan plan to significantly increase their active ETF holdings in the next 12 months, compared to 29% in mainland China. The survey encompasses responses from 100 ETF investors from mainland China, with 35, Hong Kong, also 35, and Taiwan with 30, where 53% of respondents manage over $1 billion in assets, and of which 29% have more than 50% of their portfolio invested in ETFs, compared with 24% globally. Respondents encompassed institutional investors, RIAs/financial advisors, fund management companies, private banks, and wealth managers. The full report is available via the QR code shown. Do check it out as well. Up next, the efforts of Southeast Asian regulators to encourage fund management companies to launch a wider range of products appears to be bearing fruit, with data from Morningstar showing Malaysia and Thailand fund launches up 42.5% to 114 launches over 2024. This compares to the 80 launches in 2023 and is the highest amount since 2021, which saw 174 feeder funds launched, and the third highest amount since 2015. International fund managers have been active, with BlackRock, the world's largest asset manager, launching 22 funds in Thailand and 2 in Malaysia. JP Morgan Asset Management, the asset management arm of the United States Bank, followed with 6 launches in Thailand and 3 in Malaysia, and Invesco, an American investment management firm, also saw 6 launches in Thailand. Morningstar noted that different versions of feeder funds were considered separate, so the total number of funds investors have gained access to will likely be lower than the amount of feeder funds launched. Recent regulatory changes have fueled the increase, with Malaysian regulators introducing a new framework for global FMCs to sell funds to sophisticated investors, essentially individuals with 3 million Malaysian ringgit in net assets, and institutional investors in August 2024. Thailand implemented changes to its tax regime in September 2024, which took effect from 1st January 2025. The changes will result in offshore-sourced income for tax residents being subject to personal income tax, though it does not extend to feeder funds. The changes have led to FMCs having access to an enhanced accessible market of investors, and many fund managers have plans to continue to expand their product offerings as regulations change, such as in allowing investments into cryptocurrencies and active ETFs. Other developments of note across APAC were Taiwan's ETF industry potentially seeing massive losses and redemptions to the new Taiwan dollar being undervalued compared to the United States dollar at current exchange rates. The ETF space reportedly accounted for circa 66% of all investment fund assets under management at the end of 2024, and investors gorged themselves on foreign assets on the assumption that authorities would keep the currency cheap. February and March in 2025 have already seen $1.1 billion in outflows, and April of the same year saw the same amount across one bond ETF. More redemptions may come. Taiwan is also planning to launch a sovereign wealth fund with the goal of helping Taiwanese companies expand globally and counter influence from mainland China. Specifics, including where seed funding would come from, were light, and Taiwan's central bank is generally opposed to the idea, as initial funding may come from some or all of its $582.8 billion in foreign exchange reserves. The governor of the bank stated they would not give up any of these reserves for free, but they may be willing to loan some of them out. If this transpired, Taiwan would join Indonesia, the Philippines, and the United States of America in launching new sovereign wealth funds. State Street Global Advisors, the investment management division of the United States financial institution State Street Corporation, has partnered with Smallcase, an Indian fintech, to distribute its SPDR ETF products in India across the more than 10 million individual investors that use Smallcase. SSGA will also support Smallcase with global wealth management expertise to assist in its global expansion. The Malaysia SC, the capital markets regulator of Malaysia, has initiated a public consultation regarding a proposed framework for tokenizing capital market products, including shares, bonds, and funds, but differentiated from digital tokens and digital currencies. The consultation seeks feedback on additional obligations, technology risk management, and additional requirements for licensed persons dealing in tokenized capital market products. With tokenized products increasingly launched in APAC and regulators looking to capitalize on the technology, it is likely we will see more such frameworks in the near future. So, that is this episode's section on APAC. Check out the links in our profile for this episode's other sections, and do comment if there was something that you think should have been included which was missed. Many thanks for watching. Hope to see you next time.